This is a chart of the Dow Jones going back 125 years. Right now, the markets are pushing up on that top end of this kind of long-term rising trend line. Now, just from a technical perspective, that type of action is something you want to pay attention to because these are kind of major resistance points over time for the markets. And particularly when you combine that with high valuations, those type of things, it's something worth at least noting. We've been in a very, very long stretch of this market rally. We've got a compression in price, and markets are pushing up on this long-term resistance. It means nothing today, tomorrow, next week, next month. So you don't take anything like this and go immediately, it's like, oh my gosh, I've got to get out of the markets entirely. But this is always the interesting thing. So all I said the 125-year-old trend line, everyone is max bullish at the resistance trend line. And that's very true. That's the way it always is. You go back to 1929, we're max bullish at the trend line. Go back to 2000, you're max bullish at the trend line. 2008, you're max bullish. 2021, you're max bullish. So again, you're going to have these corrections off of resistance. That's why it's called resistance. You should not use this chart to get out of the markets and worry about, oh my gosh, we're going to have this major correction, because corrections don't happen that way. They don't happen tomorrow. You're not going to wake up tomorrow and the market's going to have this big correction. The point is to understand that these dynamics exist so you can manage risk better in your portfolio. And this goes with any asset class. Everything has resistance points that eventually are going to break and you're going to have a reversal to the mean. That's why reversions to the mean are the most powerful force in investing over time. And you have to respect that because they're going to occur. But it doesn't mean today, it doesn't mean tomorrow, next week, next month, even this year. It could be next year, it could be 2 years from now, but it's worth paying attention to. If you have 20 years to your time horizon, don't pay attention to anything like this. Here's the problem with that statement. Let's assume this is 1999. And you disregard that statement. It was 13 years before you actually even broke even on an inflation adjusted basis. So great, you got a 20-year time horizon. You spend 13 years going nowhere out of your 20. So now you have 7 years left on your time horizon to get to your retirement goal. You didn't make it. There are 3 periods in history where you had 20-year returns on an inflation adjusted basis that were negative. So the point about this is that don't dismiss these types of data points entirely out of hand and just assume that somebody's calling for a crash. I'm not calling for a crash at all. But what this does suggest, when you combine this type of analysis with high valuation, with what's going on economically, financially, etc., you're looking at a period of returns that could be, not will be, could be substantially lower than you're used to and keep you short of your investment goals and time horizons.
Catch me daily on The Real Investment Show. The link is in the description.